Most homeowners who take their finances seriously feel prepared. They save consistently, they budget carefully, they plan for the long term. From the outside, everything looks responsible, and by most standards, it is. Yet there's a financial risk most homeowners never actively prepare for. Not because they're careless, but because the risk is quiet. It doesn't demand attention. It doesn't fluctuate daily. And it doesn't feel urgent until the moment it suddenly is. Some financial risks announce themselves loudly: market swings, rising interest rates, unexpected expenses. This one doesn't. It sits quietly in the background, assumed to be handled. That risk is assumed coverage. The quiet financial risk most homeowners aren't prepared for isn't missing coverage. It isn't careless decisions, and it isn't ignoring finances. It's the assumption that coverage will work the way you expect, without ever having tested how it actually applies during a real claim. This risk doesn't announce itself. It doesn't show up in a budget. And it often goes unnoticed until a homeowner's claim forces the issue, when timing, options, and flexibility are already gone. To understand why this risk is so damaging, it helps to see how it shows up in real life. Here's one example. A homeowner experiences a supply line failure under a sink. Water spreads through cabinets, flooring, and walls. The damage is extensive, but not unusual. The homeowner assumes the loss will be covered under the dwelling limit. What they discover during the claim is different. Their policy includes a water damage sublimit. Coverage is capped at a fixed amount, and repairs exceed that limit by tens of thousands of dollars. Nothing was denied. The claim was technically covered. But the uncovered portion drains emergency savings and delays repairs. Later, the homeowner admits they never knew the limit existed and never thought to ask. This scenario is so common it appears repeatedly in consumer complaint forums and insurance discussions. According to the Insurance Information Institute, water damage and freezing account for a significant share of homeowners' insurance losses each year, far more common than large-scale disasters. Here's another example. A homeowner suffers wind damage to part of a roof and adjoining interior flooring. The damaged materials are discontinued. Matching the existing roof and floors isn't possible without replacing larger sections. The homeowner assumes, if it can't be matched, they'll replace it. What actually happens is different. The policy only pays to repair the damaged portion. No matching coverage applies. Large areas remain visibly mismatched unless paid for out of pocket. Again, the claim isn't denied, but the financial outcome feels like a failure. This type of dispute shows up frequently in National Association of Insurance Commissioners' complaint data, not because damage wasn't acknowledged, but because coverage applied differently than expected. For years, until recently, it's been considered quite normal. Most homeowners set up coverage at purchase and trust that it's being reviewed periodically for their benefit. Because of this assumption, responsible homeowners feel that they can then focus their full attention on other areas to grow their investments. Meanwhile, insurance quietly renews in the background. Risks change. Policy language evolves and becomes more restrictive over time. Construction and rebuild costs continue to rise, often faster than coverage limits. Here's the uncomfortable truth. Assumption isn't a sign of carelessness. It's a natural byproduct of trust. Most homeowners trust that coverage was set up correctly. They trust that it still applies the way they expect, even years later. And they trust that if something important changed, it would have been brought to their attention. That trust usually works, until a claim becomes the moment when assumptions are tested under pressure. And claims never arrive at a convenient time. Once damage occurs, options shrink quickly. Coverage can't be expanded. Limits can't be increased. Endorsements can't be added. When coverage falls short, the impact goes far beyond the repair itself. Homeowners often face large out-of-pocket costs, depleted emergency savings, increased debt, delayed or partial repairs, and long-term financial strain. These setbacks don't always cause immediate financial collapse, but they can quietly set homeowners back years, especially when combined with other financial obligations. This is where preparedness stops being theoretical and becomes measurable. At this point, many homeowners might be thinking, isn't this what my agent is for? What most homeowners believe. Many homeowners assume their insurance agent reviews their entire policy every year, checks for coverage gaps, and proactively alerts them if something could cause a problem during a claim. The reality? In most cases, agents do not perform a full, line-by-line policy review unless the homeowner specifically requests it, and even then, the review is often limited in scope. Annual policy reviews typically focus on billing, renewals, and whether the policy is still in force, not on identifying hidden limits, exclusions, or claim-impacting provisions. Verification doesn't mean replacing your agent or second-guessing past decisions. It simply means confirming where you stand before a claim forces the answer. Because when coverage is only understood in hindsight, the surprise isn't just frustrating, it's financial. That's the purpose of the coverage gap check. It isn't a diagnosis, it's a screening. In about 60 seconds, it helps identify whether your current coverage may be exposing you to unnecessary financial risk before a claim forces that discovery. Most homeowners don't discover coverage risks until damage has already occurred, when options are limited and changes can't be made. If you want clarity before that happens, start with the 60-second coverage gap check. It's free, takes about a minute, and helps you see whether your current coverage may be exposing you to unnecessary financial risk. Final thought. The most dangerous financial risks aren't always dramatic. They're the quiet ones, assumed, untested, and revealed only when timing makes them expensive. True financial preparedness isn't about hoping coverage works the way you expect. It's about knowing where you stand before it matters.